time we answer a question on your stock in a little segment we like to call Your Stock, Our Take. Buy, sell, or hold. Tricon. We got to move on to Tricon.
Yes.
Brennan, you've got this one, a client. Do you want to read the tweet or email or what? I don't even know where it came in.
It came in
somewhere
on Twitter. It was a direct message. I kind of I paraphrase it here, but he's wanting us to look at Tricon Residential. He indicates that it appears to be trading at a discount with an acceptable balance sheet and tailwinds at their back with housing shortages and massive immigration inflows. So yeah, let's take a look at the business here. So Tricon Residential Inc., TCN on the TSX, currently trading at a price of about $10.59 and has about a $2.9 billion market cap and a dividend yield of about 3%. So Tricon is a rental housing company focused on serving the middle market demographic. Tricon owns and operates approximately 36,000 single-family rental homes and multi-family rental units across United States and Canada. They actually recently got rid of the multi-family rental side of the business not too long ago, which I will get into once we look at the financials there. And essentially, the business primarily focuses on the U.S. Sun Belt region, which is home to about 40% of all U.S. households. And as you can see in this slide from Tricon's investor presentation, its net operating income primarily comes from these high population growth areas. So jumping right to the financials here. So net operating income for the quarter was $73.7 million, an increase of about 24% from Q4 of 2021. Revenue from single-family rental properties was up about 45% to $180.9 million, and this was driven primarily by about 23% growth in the single-family rental portfolio and a 9.4% year-over-year increase in average effective monthly rent, from about $1,600 a month to about $1,740 per month. Now, revenue from the private funds and advisory services was down slightly to about $14.8 million, driven by no performance fees being recognized in the quarter, as well as a decrease in property management fees following the sale of Tricon's remaining interest in the U.S. multifamily rental portfolio during the quarter. And on this point, if we look at Q3 of 2022, you can see there, on this point, if we look at Q3 of 2022, revenue from the private funds and advisory services was about $112.5 million, which was inflated due to the accrual of performance fees earned from the sale of Tricon's remaining 20% equity interests in the U.S. multifamily rental portfolio following the quarter end. So I just wanted to, point that out if you guys kind of saw that anomaly and were thinking, what the heck's going on over there? So adjusted funds from operation for the quarter, or AFFO, was up about 143% to $88.7 million or 28 cents per share. And as of December 31st, 2022, Tricon held about $204 million in cash and debt and leases of about $5.7 billion, providing a net debt position of about $5.5 billion, and a trailing net debt to FFO multiple of about 23 times. The company also, they don't break out their adjusted EBITDA, but in their investor presentation, they said that they have a net debt to adjusted EBITDA multiple of about 7.2 times as at the most recent quarter. And looking at the debt, about 71% of the debt is fixed rate, while the other 29% is floating rate. So more is fixed, which is good. And on the valuation metric, the company trades with a trailing price to AFFO multiple of about 12 times. So looking at the company's guidance, they did provide some guidance here. So you can take a look at that just on the slide as well. I did want to mention a comment just from the president and CEO, Gary Berman. He says, as we look ahead to 2023, we remain focused on growing our single family rental portfolio so we can serve thousands of more families who are in need of high quality, relatively affordable rental housing. Our guidance for 2023 reflects a gradual acceleration of acquisitions over the course of the year, albeit at a slower pace than 2022. So they are expecting, growth to slow a little bit, as well as strong same home net operating income growth, largely offsetting the impact of higher interest expense in our FFO profile. We are encouraged by the resilience in our January operating metrics, the emergence of green shoots in the debt markets, and stability in the resale housing market that all point to another year of strong operating performance. So, they do have a good outlook towards 2023, despite, what's going on in the economy. So to conclude, I do think that Tricon is an attractive business operating in high population growth areas, trades with a reasonable price to AFFO multiple, pays a nice dividend yield, and has a reasonable balance sheet for a REIT. But however, if I was to choose between Tricon or the REIT that Keystone that we have in coverage, which focuses on the Sunbelt region as well, so it is comparable to Tricon, I would personally pick the one that we have in coverage. And the reason being is I'll go over it here. So number one, it pays a better dividend yield despite it actually paying out, more of AFFO for the dividend, but still it pays that nice 3.8% yield compared to a 3% yield from Tricon. It also trades with similar valuation multiples. So both are trading at a trailing price to AFFO multiple of about 2 times. The company that we have in coverage has a more attractive balance sheet. For example, if we look at the net debt to FFO, Tricon's is about 23 times, whereas the company that we have in coverage is about 16 times. And the percentage of debt that is fixed rate is quite a bit higher for the company that we have under coverage, at about 90% compared to 71% for Tricon. And last but not least, the company that we have in coverage is projecting similar growth rates for 2022, but growth per share based on AFFO is anticipated to essentially be stronger. So, I do think that it is a good business, but that's really what it comes down to is this the best REIT or company operating in the Sunbelt region that I could choose? Well, to conclude, I would pick the one that we have in coverage. Okay, now I'll open it up to you guys.
Yeah, it's a good summary. I think the issue here is, the guidance, not the guidance, but the estimates out there. I'm looking at a report on the company right now, looking at adjusted FFO per share, around 64 cents this past year, and 44 cents expected next year, or this is 2023, and then 49 in 2024. So, still 2 years out, not exceeding in terms of what you're looking at in this past year's FFO on an adjusted basis. We'd like to see growth there. And like the notes, they talk about from home acquisitions, the increase in financing rates has significantly lowered the opportunity sets for homes, which can be acquired currently for Tricon, generally underbidding for homes to achieve a 5.5 to 6% cap rate target. That's what they're bidding at to achieve that target cap rate. But Tricon they expect to accelerate as the year progresses in terms of home buying should interest rates stabilize in the second half of this year. Again, that's if they stabilize. In many cases, I've heard if they come off, right, it would be a reason they would buy some more. So, uncertainty in terms of where their adjusted FFO goes in the near term, and most estimates are for lower adjusted FFO in this year and next year if you just compare to the trailing 12 months. So that's one of the reasons why you see the share price come down. And, as opposed to the company that we have in coverage that is operating in the US, a lower multiple, like that multiple on AFFO is going to go up this year from this company, even if it stays at the same price in terms of the units, whereas, or the share price is, and the REIT that we're talking about is likely going to have the AFFO come down, the multiple, if the price stays the same.
Exactly. So like even just like looking here, so like off of the guidance, and again, these aren't directly comparable because we're looking at like core FFO growth for Tricon, and then AFFO or adjusted funds from operation growth for the company that we have in coverage. So Tricon's looking at a 25%, decrease this upcoming
Yeah.
for 2023. Whereas again, the company that we have under coverage, they're still looking at growing AFFO, which is nice to see.
Paying the same price.
Yeah.
So
Yeah, exactly. And potentially less risk too, so